Coming up on this edition of Perspectives, another proposed federal interest rate hike, inflation, recession, economic turmoil. All these things are really talking about. Terminologies are being tossed around, but the question is, what do they actually mean? Well, how's it going to affect us, the average taxpayer? On today's show, my guest from Orange County Bancorp will help break down all of this. That's right. All this and more headed your way as Perspective starts now with yours truly, Daren Jaime.
What's on your mind? Express what's on your mind. What's on your mind?
Anything relevant to life, you bring it to the table. Whether you make a move solo or a movement with a stable. No fables, you speak on your decisions. Cause in the long run, it's your voice, your views, your vision. Keeping it real with many messages for you to know. This ain't radio, but DJ runs the show. Entertainment, he rocks it. Politics, he locks it. The host with the most would handle any topic. Don't forget to share your perspective with shines of light. Cause it might make a difference in someone else's life.
Make a difference in someone's life. Express what's in your heart and your mind. Share your perspective.
And hello, everyone, and welcome to Perspectives. I am Daren Jaime. Of course, we thank you for joining us. As always, you can watch Perspectives every week here on Bronx Channel 67. If you want to stay connected to us, also on social media, feel free to do so. How do you do that? Well, go to BronxNet TV. That is where you can find out about the station. If you're looking to reach me personally, of course, you go to my Facebook page, Daren C. Jaime, and then also on Instagram and Twitter at DCJaime23. There you can get some information as well as some inspiration as well. Well, as we said, today we are talking about the economy, interest rates, and what does this all mean for the average person? Well, recently, Treasury Secretary Janet Yellen was quoted as saying, quote, "This is not an economy that's in a recession, but we're in a period of transition in which growth is slowing." She recently had that comment for NBC News. Well, here to break all of this down, we've got our guest who has 20 years of investment experience. He's worked at the American Stock Exchange and built his career at some of the top firms on Wall Street. He's currently the CEO and Chief Investment Officer at Orange County Bancorp, and we are pleased to have Gus Scacco with us. And Gus, good
Daren. Thanks for having me. I appreciate it.
And I appreciate the time that you're spending with us because it's much needed and much necessary, especially now as we're trying to break all of this down. As we know, the Fed has raised interest rates a couple of times, a lot of concern on the part of people as inflation continues to rise. Give me a sense of right now, from your perspective, of where we are economically.
Okay, first, I'm going to take a step back because where we came from is important.
Right.
So we went into COVID and we ended up closing down the economy. We closed supply chains. We basically worked from home or we stopped work. And we ended up having the government, which did the right thing. They put money into the economy through PPP and a couple of other programs, but it put money into consumers' hands and businesses to keep them afloat. And what ended up happening is you close the supply chain. So we actually are in a period where we came out of it, but we have too much demand and not enough. We have not enough supply. So that's very different than what we're used to. When you go into a recession, stores have too much inventory. You end up having things that have to be worked off, whether it's financing, whether it's inventories. There's too many goods and not enough sales. In this instance, there's too much sales and not enough goods. So that caused inflation because just think of it. If you're someone that tried to buy a car a year ago, you couldn't find one. Right? There weren't enough computer chips because we closed down the supply lines, and you ended up having, not to get into the weeds, but container ships were backed off the port of Los Angeles and Long Beach. And to give you perspective, if you put all of them back to back, they actually would reach from New York to Columbus, Ohio. So that was the most inventory that's ever sat at sea outside of the U.S. in history. So we get a lot of things from the Far East, from other parts of the world, and they come here to the States and we consume it. So all of that stuff was backed up. Now, if you wanted to buy a TV, if you wanted to buy anything, really there was short supply on it. Now we've alleviated all those problems. So stuff is starting to come in and people are going from buying goods to wanting to go to a restaurant. The problem is there's not enough workers, right? We talked about it before, Daren, that there's not enough supply of workers and you ended up pushing up prices for salaries and a whole host of stuff. So that is one of the things that have helped push up prices and cause inflation to kind of come into the play. So we're talking about different slides that we have. As an example, if you were to go to page 5, you can see approval ratings of President Biden. And I'll use this, and I'm not making a political comment. It's just whoever's in office right now is considered responsible. So that chart that we're talking to shows the black line is President Biden's approval rating, and you can see the red is inflation. As inflation went higher, his approval rating went down. And this is just an overview of anybody that's in office right now. They're considered that, their whole reason for being is to get inflation down. So they basically have given the Federal Reserve, they told them take inflation down. And the toolkit that they have is very limited. They can usually cut rates is the normal playbook to get us out of a recession, because you buy more goods. You have, if you think about it, if you're going to buy a house, financing price, the price that you finance at in terms of the rate of the mortgage comes down, you can buy more house, right? And more people can afford a house. Now, on the flip side of it, they're trying to slow demand down. So what do? You raise interest rates. So that causes less houses to be bought, less businesses to invest, because I'm buying a piece of machinery. Now, all of a sudden, it doesn't make sense to buy that piece of machinery on credit. So all of those things come into play, and it slows the economy down. And that's what we're doing. We're taking a playbook that was last used after World War II. World War II, everybody was working to basically make munitions, tanks, things like that. All the soldiers had money. They came back. They wanted to buy a Dodge or a Chevy, and there were no Dodges or Chevys to be bought. So inflation, and you can look this up, inflation hit 20%. If we thought we have it bad now, there were too much demand and not enough goods back then. Inflation went to 20%, so they raised rates until demand slowed. And that's what we're doing now. We're raising rates to the point that demand slows. And that's what's happening as we speak. So cars are now coming in you can go to a car showroom and you'll find them. If you're looking to buy a house, there's less people that are demanding a home. We don't have bidding wars to the same extent, if at all. And you have more goods coming through those supply chains. So those boats that were off the port of Los Angeles and Long Beach are actually working their way in. And if you go to a store right now, and talking about another slide, I believe it's on page, sorry about that, page 8, will list the 10 largest retailers, and those show what the inventory levels are. They usually have inventory levels that are about, this is the growth, the percentage change. It's usually equal to whatever sales are. In Walmart's case, it's 10 times. So they're sitting on so much inventory that they have to actually discount it. So stuff you couldn't buy last year, they're selling at a discount this year. And that goes across almost all retailers.
Yeah, let me walk through this here. So we see Amazon, and Amazon has almost a 47% inventory. You look at Walmart at 32% inventory. Home Depot coming close to 32%. And I'll stop at Costco, 26%. And well, let me go to the big number here. Target inventory, 43%. And so when we see these numbers, obviously a lot of concern. If you're in the business of economics, you're saying this doesn't look particularly too good.
Well, it's actually taking prices down, right? Because if they're discounting, it means that whatever you were paying last year, which was marked up, is now getting discounted. So if you went online after this program, you'll see that on the websites, almost everything's there is 20, 30, 40, in some instances, 70% off, because they have to clear out the inventory. So we don't have the logistics problem, which caused prices to go higher. And this is going to kind of bring inflation down. We've passed the peak of inflation. So now it's coming down. The question is, how fast does it come down? All right. And it probably gets back to somewhere between 4 to 5% by the end of the year. And then next year, it'll come down even more.
And when we look at the inflation coming down, you're talking about how it's going to get there by next year. Talk to me about these interest rate hikes, because as we see interest rate hikes continue to take effect, I think many Americans say, how much higher are we going to see these things go?
They're going to squash inflation, because inflation is something that is insidious. What do I mean by that? If I have a business and last year inflation kept raising prices, I hold on to inventory, because the longer I hold it, the higher the price is. and the more profit I make. If inflation comes down, the reverse effect happens. We're so used to getting goods right away. Most companies didn't want to sit on any inventory. They got rid of it as quickly as possible. But now, if you're somebody that bought something on Friday and you closed the doors over the weekend, Monday you made a profit by not doing anything as prices continue to rise, right? So if you can cut inflation and slow it, now all of a sudden, you're trying to go back to where you were, where you're just getting rid of it as soon as you get it. So it basically changes how businesses affect things. They don't hold on to goods as long. They want to get rid of them. People don't bid up prices the same way. And as someone that's making a purchase, right, you might hold back and not spend as much because you know what, you're going to wait. You want to wait because you're expecting that, maybe I don't have enough money for all of the goods that are out there. And I change my behavior because of it. So getting rid of inflation gets the economy back to what we'll call a normal. I don't know what that would be considered moving forward, but it'll be more normalized than it is now.
Gus, a lot of people are talking about the word recession. We're hearing from Washington, they're not using the word recession. We're hearing the word slowdown. There's a difference between a slowdown and a recession. But give us your analogy as to what we're hearing during this time, and how long do we anticipate this recession/slowdown to last?
Daren, if I were to go to, I'll use pictures again to kind of paint a picture. You go to page 6, there'll be 4 boxes. And recession is basically 2 quarters. This is lightly defined as 2 quarters in a row of negative GDP growth. So we might go into a technical recession. However, it's one where it's going to be, people keep talking about that it's not going to be that bad. And the reason why is these 4 pictures. So residential investment as a percentage of GDP, that's houses. All right. So there's not too many houses out there that, they have to work off. People are trying to play catch up with houses that were started but not completed. Business fixed investment, that's basically buying equipment and things of that nature. There needs to be an uptick there, and that will happen. There's just not enough inventory. So that shouldn't, there's a need to buy more of it. So that will help the economy. If I look at light vehicle sales, we normally sell 17 to 18 million cars and trucks in the US. We've only been selling around 12 million. There's a pent-up demand for it. Anyone watching this has either tried to buy a used car, it's almost as expensive as how a new car would be a few years ago, or a new car and they can't find it. That's why we're saying that we don't think that whatever recession we have is going to be all that bad, because we think back to 2008, it's not anything close to that. This isn't something that's caused because of too much leverage, too much borrowing, basically. All of us that are watching this will probably have a better balance sheet, meaning more cash in the bank and less debt than we had in past years. And most companies are the same way. So they have flexibility. There's the need to rebuild inventories, except for Walmart. So you're going to have more goods produced that help the economy. And you have people that are probably sitting, although they're nervous, it's probably in one of their, probably better than they have been in, past recessions going into this.
And, if you're a stock player and you're one that's in the stock market, this has not been a great time for anybody that's been in the stock market. Just as from your perspective, talk to us about how people have had to really just weigh this out. And there were some people who cashed out, but a lot of people said, I'll try to ride this out, given the fact that we know that this might not last, that we know that the market always bounces back up.
It depends on what your time frame is. Daren, you're a young guy. I'm an old guy. So if you have, 10, 20, 30 years, you can basically live through these cycles. And if you're not invested, you kind of miss out on the upward bias that the market tends to have. You're betting on America when you invest in the stock market. So, by being out of it, if you're an older person, you need cash, or you're going to be buying something like a house or a car, you want to set cash aside. You might own bonds, but not being in the markets at all during an inflationary period. If I have $100 and inflation's 9%, that means next year I only have $91 worth of purchasing power. So by being in the markets, you kind of offset the inflation. Even though the market has gone down, it tends to, as things improve, you tend to make up for the inflationary impact that you have. Because think of it, if I'm buying a company's stock, you're buying a piece or ownership in a company. So Starbucks is an example. If they raise prices, they're offsetting the inflationary impact. You're benefiting from that as an owner of the company.
Going to take a quick break and come back with more with Gus as we discuss the economic impact that so many across the United States and the world are now feeling. When is the prediction of it getting any better? And what could we do in the meantime? Stay tuned. This and much more here on Perspectives. Welcome back to Perspectives. Daren Jaime here with you. We're continuing our conversation with Gus Scacco as we are breaking down the present plight of the economic status that we have here in America. Some tough times that we're really dealing with, Gus. And, we talked a little bit about this earlier. I want to go back because I think a lot of people have been asking this question. I need some answers. I go out, I find out there's not enough people, whether you're in the hotel, whether you're in the work environment. And it seems as though that nobody's going back to work. And where are all these people? And you got to ask the question, where are the people when we have this huge employment vacuum? Talk to us and help us make some sense of some of this.
We have a couple of things because of COVID, and we still have some lingering, things that are in place because of it. We get a lot of seasonal workers for hotels and vacation areas or working at restaurants that come from overseas. So Jamaica, Ireland, South Africa, a number of different countries, they'll come here on a seasonal visa and work and take up some of the spots. So we're in New York State, and there's a hotel that's north of New York City by about 50 miles, major hotel and resort complex. They can only handle 50% of the demand because they couldn't get those seasonal workers. So that's still in place. It's slowly dissipating. So that's one. The second thing is when COVID came, a lot of people decided, you know what, I'm retirement age. I'm not going to chance it. And 3 million people or 8 million people came off the rolls in a short period of time. It's like, imagine having, something happening just in a short period of time. You can't really adjust that quickly. So we're still trying to do that. But a lot of those people are actually coming back. As someone that directs, retirement money, one of the things that you try to do is tell people, when you retire, one thing that you have to get used to is 40 hours, 50, 60 hours. There are a lot of hours to make up. So all of a sudden you have all of this time and you're not sure what to do with it. So a lot of those individuals that retired, their 401k plans might be down a little bit. They're actually coming back to work in little by little. It's layering on. And then lastly, the president ended up continuing that we have COVID as a national emergency. By doing that, it offers up people more. They have money for or services that allow them to get food stamps, to get housing, and a couple of other things. We ended up going from before COVID to 70 million that basically got those types of services to now 90. And until that kind of dissipates over time, those workers are available once they come off, from having those services provided for them. So those are the things that actually shock the system and are still causing us to play catch up in terms of labor.
Walk me through a little bit about the government at this time? Because we know that the government can do a great job in terms of messaging and helping people to navigate through this. What can the government do to be able to help people navigate through these tough and turbulent times?
I think it's really, educating people and then having the services in place to allow them to get back to work, whether it's, types of daycare or things like that. Schools being open were a major thing that was an impediment to get people back to work. And in terms of inflation, what the government can do, they really can't. They're doing what they can because the toolkit that they have is not really made for this. What they need to do is really incentivize businesses to increase supply. Why is that? It's because instead of having 4 items for sale, you need to have 6 to 10 in order to meet the demand, but also keep prices down. All right. So that's first and foremost. So that's number one. Number two, people will probably change the way that they spend. And that's what in the short term you can do is substitution effect. It's a normal thing, right? You end up, I'll use food as an example. At one point, people were probably buying a lot more, high-end goods or things at the store that they now don't. They're substitutes for it. So that's like one of the offshoots. So it's really having to be resourceful more than anything else. And, it's a tough time and things will get better, though. That's the one thing I will say to your audience. It's just you need to get through this period and you need to open up supply more than anything else. And it takes longer than just flipping a switch. So hopefully, government is listening to this and they'll move in that direction.
You touched on families understanding the times that we will get through this, but in the meantime, it's a mean time for some families.
Yes,
How does a family go through getting through these tough and really challenging times, given the fact of the economic hardship, inflation rates, recession / slowdown right in our face?
I don't have a silver bullet, but really that substitution effect they talked about, that's number one. Longer time periods in terms of having to do something. So whether it's financing something, you're going to do it over a longer time period. And it's also being smart, right? You're not going to make, impulse purchases so that you have more cash, that you're able to do things. And also you want to keep a little bit of a buffer. You want to have some cash on hand if you can, so that you're able to meet short-term, needs. And you kind of have that as a built-in, we'll call it savings account, so to speak. So there are a couple of things you can do, but there's no magic bullet, and it's going to take a little bit more time. And it's really something that has to be affected by increasing supply more than anything else.
Gus, you're the guy that looks at the numbers all the time, and that's you've made that your life's passion. Talk to me about, as you look at the numbers, what really sticks out to you in the middle of these times?
Oh, wow. There's a number of different things. Number one, it's if I'm looking at just how things are this is the first time I've ever seen it's such a bad time, but yet you can't get anything and that everything is crowded. So this is the only other time where there was too much demand and not enough supply was after World War II, as we spoke about earlier. So, it's not something that happens that often. It's because there was a shock to the system, more or less on the economy. But I think how people look at things and how they I think got back to families and things of that nature that, we always look outside of what's really important. So by having COVID, having shared time and doing things like that, it's changed how people look at how they want to approach things, I think, a little bit more in a more sensitive nature. In terms of the economy itself, I didn't think I'd live to see inflation back to these levels, but I think that, believe it or not, we actually have a pretty decent handle on it relative to what could have happened. I mentioned earlier World War II, inflation got to 20%. We got to 9%, and we're probably somewhere in the neighborhood of, call it 8.5 to 7, somewhere in there, and we'll head lower. But we actually have lived through these before, so we know how to approach them as the future moves forward.
Do you get the sense that we've moved through the worst, or are we still anticipating the worst yet to come?
I think we've moved through the worst, and I put up those charts before that show just too much supply now. So you're getting supply in terms of the goods area. It's now really getting more labor back to work and getting normalization in prices. So U.S. is one thing you always have to say is people are have a lot of ingenuity, and they'll figure out a way, whether it's some sort of a change better technology, more productivity, substitutions of things. But over time, we will get around and figure out things so that we can get back to, a normalized level where inflation isn't as crazy, and that, you can get supplies of goods and things that you need for your family. So I think we're going to see a period actually over the next 10 years where there's more productivity because of more technology being used and people being trained, in new areas. I mean, I always go back to the example 30 years ago, you didn't know what a cell phone was, and now it's a part of everyday life. There are things that are coming out and things that we utilize. We're doing, a call remotely or a filming remotely from, 2 different areas. That's because technology has been enabling us to do this. We wouldn't have been able to do this, and the cost would have been prohibitive just 5 years ago. So just think in those terms. There's a lot of stuff that's on the come that we'll see over the next couple of years that adds a lot of productivity to our daily lives.
Yeah. I was having a conversation with somebody just before we went to air, talk about McDonald's and their earnings report saying that they didn't do as well as they anticipated to do. And my friend said, well, when McDonald's isn't doing well, I can guarantee you the nation isn't going to be doing well either. But there's a lot that we have to really look at and say that it's not just a struggle individually, but you got corporations that are struggling. You've got, organizations that are struggling, and you got the average everyday person that's struggling. Give us, before we wrap up, a little bit about how you can compare this to 08, because I got a little bit about under 2 minutes left. I just want to take a look at where we are today, because people are like, is it as bad as 08? And I'm like, no, I don't think it's quite as bad, but you're the man with the numbers. Give us your breakdown.
I'll tell you this, Daren. We end up having people always ask us, is this 08 again? And it's not. 08 was caused because there was too much excessive debt that's out there. Right now, balance sheets for individuals and companies are the best that they've been probably in about 40 years. That's number one. Number two, 08, you ended up having to work off all of this inventory. You had housing inventory that up until 4 or 5 years ago was still sitting out there that had to be worked off, and people couldn't spend. You couldn't get higher end goods right out to market. People were not willing to buy it. We probably have now kind of reversed back, but we're in an environment now where there's more normalization coming to us, right? Supply and demand are coming back in balance. And, the worst thing is the inflation. But if you're looking at 08, this has nothing to do with it. When you go into a recession, there are no jobs. So you have jobs, you have, companies that are looking to pay up to get employees, and you have goods and services that are coming back into a normalized levels. And we'll see what happens with the Fed. As they increase rates, it slows things down a little bit more, but they'd rather get a handle on inflation now so it doesn't become a bigger problem into the future.
Yeah. Gus, we got to leave it there, but I want to thank you so much for being with us. Some very insightful information. Hopefully, we'll be able to get you back soon, break down some more of this as we continue to navigate through this and giving us some eyes as well as some tips as to how to move things forward. Gus Scacco, thank you so much for being with us.
Daren, thank you for having me. I appreciate it.
Yeah, there you saw his information at the bottom of the screen where you can reach him on his website. Take the time to reach out to Gus if you have any questions or concerns. Want to thank him for being with us, giving us some insight, some information, and the word of the day, some perspective. For all of us here on the Set of Perspectives, my producer Curlew Burton and myself, we want to thank you for joining us. Until the next time we meet, stay safe, share your perspective with somebody else. It just might make a difference in someone else's life.